Have you ever felt that the world of investing is full of traps and mistakes waiting to happen? What if I told you that even experienced investors still make critical errors when they first start out? In today's video, we're diving deep into the top 5 investment mistakes beginners make again and again. And trust me, even seasoned investors have fallen into these traps. Let's make sure you don't fall victim to the same mistakes. So let's jump right into it. 1. Not using a tax-advantaged account. Have you ever wondered why some investors seem to get ahead faster, even when they aren't making huge gains? The secret might be as simple as tax-efficient investing. Here's the reality. If you're not using tax-advantaged accounts like a Roth IRA, you're leaving money on the table, and not in a good way. In the U.S., tax-advantaged accounts like the Roth IRA and 401k allow investors to avoid paying taxes on their earnings, which means more of your money stays working for you. If you contribute $20,000 annually to a Roth IRA, all of that money grows tax-free. The Roth IRA allows for tax-free withdrawals after you turn 59 and a half, so any interest or growth that occurs within the account is all yours to keep. But here's the catch. If you're not using tax-advantaged accounts, you could be missing out on huge savings. A general investment account might seem like a viable option, but the problem is you will have to pay taxes on dividends and capital gains, which can significantly cut into your returns. For example, if you earn $1,000 in dividends or capital gains, you may lose 15 to 20% of that to taxes, leaving you with far less than you expected. With tax-advantaged accounts, all of your money remains untouched by taxes, allowing your investments to compound and grow much faster. It's like having an invisible friend helping you out in your investment journey. Be sure to always maximize your Roth IRA or 401k contribution limits each year, so that your future self can benefit from the tax-free growth. By avoiding this simple mistake, you can significantly increase your chances of a wealthy retirement. 2. Misaligned risk appetite. How many times have you heard someone say, "I wish I knew how to invest, but it just seems too risky"? What they often don't realize is that risk doesn't have to mean chaos. It's all about matching your investments with your personal risk appetite. When you first start investing, it's easy to get caught up in the excitement of the markets or to simply follow the crowd. However, not all investments are created equal. Some investors rush into high-risk, high-reward stocks like tech companies or cryptocurrencies without considering whether these align with their personal financial goals. If you're not comfortable with a higher level of risk, then it's vital to understand your investment horizon and goals. For example, when you first start investing, you might be tempted to allocate a large portion of your portfolio to stocks or speculative investments. However, if your goal is long-term wealth building, you might want to focus on a diversified portfolio with a more balanced approach. Don't fall into the trap of chasing quick gains or trying to follow the trend. Instead, align your portfolio with your comfort zone and your financial aspirations. For those with a long-term horizon, it may make sense to be more aggressive, while those closer to retirement may want to adopt a more conservative approach. Don't let your emotions drive your investments. Understand your personal risk tolerance, and then build a portfolio that suits your needs, so you won't panic when market volatility hits. Diversification is also key, and aligning your risk level with your investments will lead to less emotional stress when the market experiences dips or corrections. 3. Paying high fees for your account. How much is that small monthly fee really costing you? You might not notice it at first, but those small fees can drastically impact your long-term wealth. It's like an invisible drain slowly sucking away your potential profits without you even realizing it. Many new investors fail to consider the fees associated with their investment accounts and funds. Over time, fees compound and erode your returns, leaving you with much less than you originally anticipated. For example, if you pay 2% in fees every year over 30 years, your portfolio will be significantly smaller than if you paid just 0.1%. In fact, the difference could be a staggering $240,000 less by the time you retire. The worst part? Most investors don't even notice the fees because they're automatically deducted or hidden in the small print. These could be management fees, commission charges, or fund fees, all of which chip away at your investment value over time. It's important to shop around for low-fee brokers and cost-effective investment funds. By being proactive in understanding the fee structures, you can keep more of your money working for you, rather than handing it over to the financial institutions. Be sure to always read the fine print and look for low-cost options like index funds or ETFs, which typically come with much lower management fees. Your goal should be to minimize costs so you can maximize returns. Don't let high fees eat away at your long-term growth. Instead, prioritize using low-cost, tax-efficient investment options to build your wealth over time. 4. Buying based on past performance. Have you ever looked at a stock's recent performance and thought, "Wow, this stock is killing it. I need to buy it"? It's a common pitfall that beginners fall into, buying stocks because they've performed well in the past. But here's the truth. Past performance does not guarantee future success. Take, for example, the Magnificent Seven, the top 7 stocks in the US like Tesla, Amazon, Apple, etc. While these companies have shown impressive returns recently, past performance is just that, history. It's easy to get caught up in the excitement of high-performing stocks, but history has shown that the top performers today weren't always the top performers in the past. For example, in 1990, not a single one of today's top-performing companies was even on the list of the top 7. In 2010, it was Apple, Microsoft, and Google, and while they've maintained dominance, many other companies fell off the list entirely. This teaches us an important lesson. Don't just buy a stock because it looks good based on recent gains. Do the research. Look at the fundamentals of the company. Assess its long-term potential. Is it undervalued? Does it have a competitive edge? Don't get distracted by the past. Focus on the future. Investing based on past performance can lead to unrealistic expectations. The reality is that no stock is guaranteed to continue its success indefinitely. By relying on solid research and future projections rather than past performance, you'll be in a better position to make smarter investments. 5. Short-term thinking. Do you check your investments every day, anxious about fluctuations? It's easy to get caught up in the daily price swings, especially in the volatile world of stock markets. But if you focus on short-term performance, you might miss out on the bigger picture. The key to successful investing is to think long-term and remain focused on your financial goals rather than on short-term fluctuations. Imagine investing regularly in the market, but getting discouraged by a dip in your portfolio value over a few weeks. It's normal to see short-term dips, but it's crucial to stay patient and focus on the long-term horizon. The market is a roller coaster with ups and downs. However, if you've invested with a long-term plan, you'll ride out the storms. Short-term thinking might lead to panic and hasty decisions. But as Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. If you can stay patient, invest with discipline, and focus on your long-term financial goals, you will be in a better position to succeed. Don't let the noise of daily price movements distract you. Consider this. Time is your biggest ally in investing. The longer you stay invested, the greater the potential for your portfolio to grow. So, think in terms of decades, not weeks. When in doubt, stick to your plan and avoid short-term decisions based on emotions. To recap, these 5 investment mistakes can significantly impact your long-term wealth, but they're all avoidable. Start using tax-advantaged accounts. Align your portfolio with your risk tolerance. Keep fees low. Focus on fundamentals instead of past performance, and think long-term. By avoiding these common pitfalls, you'll be on your way to building wealth more effectively. Don't forget to like, share, and subscribe to stay updated on more tips for smarter investing. Thanks for watching, and see you in the next video.